All right, so we've got some foundational concepts here, but now let's get into some really the detail stuff, and that's the indicators. This is the tools, the things we're going to actually use to help us, make decisions around securities to buy or sell, for example. And indicators are really at the heart of technical analysis, and it's really our technical tools we're going to use to help us be successful. And indicators are all based on things like math and data and trends and all that. It's very focused on trends, of course. You want to anticipate trends and then make your decisions based on where things are headed or where the trend is headed. And technical analysis and using indicators is also all about eliminating emotion. You're not tied into, oh, I love that stock, or I love that last movie from Disney, so I'm going to buy Disney stock, or whatever. I heard a great thing about Bitcoin, or whatever it might be. It takes emotion out of it, and you're really looking at these indicators from a real unemotional way. What is the indicator telling me versus my likes or dislikes about something? And that makes them very, very good to use in that manner, very way that takes emotion out. Now, they're not perfect, because nothing's perfect. If there was, I would have one lesson, and it would be about what's the perfect indicator to use, and that would be it. But they have different applications and different ways you can use them, and some work better than others, or in certain situations or with certain types of securities. And we'll go through that as we go through the course. But just be understanding that nothing, of course, is perfect. In fact, really beware of anybody who says, I've got the perfect system or the perfect set of indicators or things of that nature. They don't. They might be able to share some good stuff and might be helpful, but just beware of anybody who's trying to sell you something for money that is the perfect answer. That's probably or it is fraudulent, because there hasn't been a perfect indicator out there yet. So indicators at their heart, what they do is they're technical tools that help distinguish between noise and an actual event. Okay, so what is that? So an actual event is something that's real, something that's happened either with a company or an organization or a currency or globally, whatever it might be. Something's happened in a broader sense or specific to that security. And it's a real live event that's going to make a change that's going to happen with trends, whether they're going up or down or sideways. Something is a real change. Versus noise, noise is things that are not dramatic, and it does not change the overall trend. It might cause it to blip up and down a little bit, but it's not going to actually dramatically change the event or change the trend, where an event definitely is dramatic and changes the trend. Or it might strengthen the trend to have it continue in a strong manner, whichever way it is. But it's not a temporary thing like noise might cause. It's a real thing. So that's the difference between noise and events. And indicators help us to separate that out so we can kind of tell what's true and what's false and what might be, really the core things that we want to focus on as far as making our buying and selling decisions using indicators when events happen. So let's look at an example of these noise and events, for example. So let's say you have a drug company, and there's, they say that the new drug that they've been working on launch will be delayed 60 days. All right, so that will cause, let's say, the stock price and things to go down for that particular company. It is legitimate, or it might go down temporarily, but it's more noise as in, they're going to be fine in 60 days, or just delayed 60 days. Versus something that's a significant event, where let's say the same thing with this new drug fails a government approval trial. That's a bad thing for drug companies. That means they might have to start all over. They might just have to pull all their research and development around that drug. Something wrong has happened, and it's going to cause a significant change in the trend. In this case, it would probably cause a significant downtrend based on that event. So you get a feel for these events and noise, and the indicators again help separate out the noise. So we think about what is actually an indicator, defining it, so to speak. An indicator is a line or a set of lines or some type of mark you put on a chart to identify events and clarify and enhance the investor's perspective, perception of the price move, and are looking for things like, is the stock price trending? Is it going in a certain direction? How strong is that trend? What's the degree of strength? And is a trend turnaround point, about to be reached, right? So that's what our indicators are telling us. Which way is the trend? How strong is that trend? And is that trend going to change or go maybe in a different direction? If we know those things, then we can make buy or sell decisions based around that indicator, or maybe a set of indicators to help confirm between primary and secondary indicators. Another way to look at this is, what do indicators specifically kind of try and identify? They're going to try to identify is a trend beginning? Is a new trend beginning? How strong or weak is that trend? Is it kind of going to be weak, or is it going to be really strong and we want to get in that trend? Whichever way it's going, up or down. Is the trend retracing? Is it got a temporary pullback, but it's likely to resume, let's say, for example? Is a trend ending and may it, change or reverse or go the opposite way, basically? And also we can use indicators to indicate a trading range, high to low. What is the range that's going on with a particular security as far as the pricing in there? And that'll help us decide. Again, all these things are designed to help us as far as whether we want to invest or not, or when we want to buy, or when we might want to sell. And if you look at each of these things, and all these different sections we have coming up are going to start identifying these things. And we'll apply concepts like these different indicators, like for identifying beginnings of trends, we might use a moving average crossover, momentum for strength of the trend, relative strength index for looking about, is it going to retrace but then likely resume the trend? How can we identify that? We could use the RSI, or relative strength. We can use multiple types of indicators for things like, for example, is a trend ending and may reverse? Well, we got patterns and breakouts and momentums and crossovers, and what's the trading range? That's things we can use too with that, like Bollinger Bands or ATR, average true range. So as you can see, we've got different ways that we can use these different indicators to help us decide what we want to do. And ultimately, what all this stuff that we're going to learn is indicators are designed to provide us buy and sell signals, or at least a warning that something might be happening, to help us to be better traders, to be better investors, to make better decision makings. And really, if you look at these different types of indicators or signals on buy and sell signals, a warning signal or a buy or sell signal, there's really kind of three broad things that they're going to talk about, or three broad ways you can kind of look at these signal types. And those are crossovers, meeting a range limit, or are things converging or diverging? So just to give a couple highlights on that, and I'll highlight some of the things you're going to learn in great detail coming up. Basically a crossover is when one line is crossing another. It's going to show things like a breakout. So you can kind of see in this quick little example, you can see there's a trading range there with these two bars on the top and right, and everything's kind of narrowly constrained. But the top right, you can see where it broke through that range, broke through that kind of artificial line we put there. That's showing that it's crossing another line, that's showing it's breaking out and that a new trend is forming. But we're going to learn all about that as we come up, as far as that. But that's the idea of crossing lines. And also we have range limits, things like, funny names like oscillators and momentum indicators, where we're going to look at what are the trading ranges and how do things fluctuate, within an upper and lower band of a trading range. And as they approach them, how are they going to, are they going to indicate things like is something overbought or oversold? Or can you combine these different types of range limit type trading and looking at things like movement and moving average indicators to signal trend breakouts and reversals? So there's kind of big broad aspects of that. And then you have these ideas of convergence and divergence, where two things are coming together. Prices are narrowing. They're starting to get closer together within a trading range. And sometimes they're diverging or getting further apart. You can see, time on the left going left to right in this example, and price going up and down as far as height. And you can see convergence where prices are starting to get closer together. Divergence where prices start to go further apart is the idea behind that. So these indicators are these broad concepts, indicators. We're going to put all this together. We're going to learn a whole bunch of different indicators and different ways that we can kind of analyze investments and analyze securities so we can make the best decisions by using these indicators, by using these tools. And that's what we're going to start learning at and start building that up from the foundation up.